Good afternoon or good morning, depending on where you are in the world. Welcome to LBMA webinars. We have a special webinar for you today. We are handing the floor over to LPPM for their PGMs update of 2021. So we have David Jollie, the Head of Sales and Market Insight at Anglo American Platinum. And we also have Justin Froneman, the Regional Chief Financial Officer at Sibanye-Stillwater. Before I hand over to the gentlemen, what I will do is I will take you through a quick bit of housekeeping. So if you have any questions throughout this webinar, please just submit them in the Q&A panel. If you don't know where they are, the questions can be submitted also through to our ask@lbma.org.uk email. So please let us know if you have any questions during this webinar, or if you are watching it back pre-recorded, you can email that through to us, and we'll make sure that we send these off to our panelists. So David, this is where I hand over to you.
Thank you very much. So it's a pleasure to be here. I'm joined by Justin, as Taylor introduced there. I'll just start briefly with a couple of sort of bits of housekeeping. One is a sort of full disclosure that it's quite cold outside, so there's a small chance that a cat may jump in front of the screen at some point. That happens, it happens, right? We'll live with it. And I'll introduce them, of course. A bit about sort of antitrust stuff. It's obvious, you know, Justin's Sibanye-Stillwater, I'm an Anglo American Platinum, obviously large producers. We're not going to say anything, I don't think, secret. There shouldn't be any issues there. But we're being observed anyway, so nothing secret, whatever else goes on. And just really to echo Taylor's point, if you've got questions, you know, put them in the Q&A box or in the chat. We're interested in trying and help people, you know, understand a bit more, or our perspectives at least, about the market. And we're going to focus, I guess, on recycling particularly, which is why we've got you here, Justin. So, you know, what was the, you know, you give us a bit of background about, I guess, maybe two things. One is how Stillwater got into recycling back in the day, and then, you know, the whether that was an attractive part of the Stillwater transaction for Sibanye as well. So kind of how that strategy has developed.
No, thanks, Dave, and thanks to the thanks for this opportunity, and to the LPPM for obviously having this forum. Yeah, two very good questions, and I think some history there. You know, this wasn't something that the Stillwater Mining Company back in the day did you know, on a whim. It actually entered the recycling market in the early 2000s. In fact, 2003 was when Stillwater Mining Company decided to enter recycling, with really a focus on autocats, and obviously we'll discuss this during this forum in terms of the differences and what that means to them. And effectively, the rationale behind entering recycling was to utilize the excess capacity that Stillwater had in its smelter and its base metals refinery. Now, you know, the ability to use that excess capacity and really depend on the PGM concentrate, which was coming down how we refer to it, down the mountain, down the hill, given that our operations are situated in the mountains, which effectively allowed the recycling to become obviously economic, and it allowed us to utilize, or Stillwater at the time, to utilize that excess capacity and to do away with some of the high costs associated with processing and refining. So that really, I guess, allowed that business to become relatively economic in a short space of time. It also allowed, as I mentioned, the plant to be utilized a little bit better, and that excess capacity. I think what we found going forward, and obviously with the focus on ESG, it was actually pretty smart business, because not only does it obviously close the loop on waste and on stuff that's being scrapped, but we've done quite a lot of work from an ESG perspective on the environmental footprint associated with recycling. And what we've actually found is that, and happy to say, given the location of our US assets, which are on the doorstep of the Yellowstone National Park, obviously there's a huge focus on emissions and how we operate. And when we've done some numbers on it, we've actually found that our recycling out of our North American assets is in fact incredibly environmentally efficient. It emits 6 times less tons of CO2 than our mining in North America, and once again, that is a really well-regulated environment to start with, uses 63 times less water, and obviously generates a lot less rock waste, 90 times less rock waste than our mining operations. So it really just, I think, from a Stillwater perspective, closes that circle on a circular economy, and so in hindsight was a very smart move by the Stillwater management at the time. Was it a strategic imperative for us when we in 2017? It wasn't. The reasons for buying Stillwater was to access what we considered a tier one asset, a very low cost asset. At the time, we had a favorable outlook on the palladium fundamentals, and with 78% of Stillwater's production being palladium, that was really one of the big focuses. The big pro for us in terms of recycling, it's a small component of our business from a cash flow perspective, but it did give us insight into recycling, which I think, given the fact that we're having this call, is a very opaque market. It's very difficult to understand exactly, what's going on, all the moving parts, who the players are, and just really how it all works. So Stillwater gave us geographical diversification. It gave us low cost exposure to what we thought was a good asset and is a good asset. And but at the same time, as I say, the recycling was a nice add-on, and it was one of the strategic elements, but certainly wasn't the be all and end all of that acquisition.
So from I guess, maybe a two-part question, which is always bad form to ask in that way, but I guess, do you see the recycling segment growing to start with, and then do you see that growing for you as well as I guess a revenue line or as a focus?
Yeah, I mean, it is a focus area for us, and once again, underpinned by ESG and about that environmental footprint. It's probably getting more and more attention internally. We are seeing, and I think we've seen this in the PGM sector for some time. I mean, probably going back to the early 2000s, that secondary supply has been outpacing primary production. I mean, for obvious reasons, in terms of the relative capital intensity of the two businesses of the two streams is obviously slightly different. But what we are seeing now at the moment is that, drawing straight lines on secondary supply growth and assuming they're going to continue to grow at, say, a 25% CAGR, which is probably the type of rate that we've seen, particularly in palladium, is becoming constrained. So yes, we expect secondary to continue to outpace primary, but we are seeing some downstream and some processing issues. Processing capacity, by its definition, isn't constrained. But we are finding that there are some, I guess, external factors in terms of technology that are becoming a bottleneck. We have to deal with things like silica carbide, which you'll know well as part of the substrates, in particular in diesel auto catalysts, that can cause issues in the smelter. So that's something that the industry is having to deal with. It's certainly not just us that are struggling with this. And then I think, working capital is a big thing, because the recycling network is very much I'm going to say, a cash on delivery business, just by virtue of the collectors having to churn and to turn their working capital and inventory very quickly. You do need deep pockets, and when prices do what prices have done over the last 3 years, our relative 3E PGM basket for a spent auto catalyst has probably gone from sub $1,000 an ounce 3 years ago to $3,000 an ounce, coupled with obviously volume growth. You just start to expend a lot of money on working capital, and that becomes a big focus. And you've got the added complexity, what we do, of making advance payments to your collectors. And of course, that just means it's cash out the door at the front end of your process versus when you actually get that cash back as that loop is closed and as you get the outturn from your PMR. So lots of moving parts. I do think the biggest challenge as an industry we are facing, as I mentioned, is the silica carbide, because we are just looking for tech that can actually help us unlock that. If you've got big smelters with a lot of capacity, it's not that big of an issue. But for us, where we do have limited capacities and we are feeding obviously concentrate and recycle material at once, you've got to be careful of that.
For those who don't know, sort of silicon carbide is often the diesel catalyst on a silicon carbide substrate. And what that really means, apart from any smelting problems, is if you were a catalyst designer in the late 1990s, which I was, and you injured your back, which I did, it was because of silicon carbide. So I have a visceral feeling of what silicon carbide looks like, quite apart from any smelting issues. So I guess you touched on something actually, which is very obvious at the moment, which is, given rhodium prices are where they are, and I won't even try and hazard a guess where they are right at the moment, but $29,000 an ounce, and they were, let's say a tenth of that a couple of years ago. Has that changed anything in the mindset of the recycling sector? So you talk about, it's very cash driven, but are people looking to take more risk, take less risk? Are they looking just to keep their working capital the same? Does it have any of those sort of weird impacts, because it's such a big change?
Yeah. So it's an excellent question, and I think I guess for people who haven't had sight of what a efficient scrap collection recycling network looks like, it's massively impressive. I mean, we deal with counterparts who have got first-class technology to understand exactly what catalysts are coming in, exactly what catalysts they're collecting. We've had to develop recipe books. The industry, I say we, the industry, have had to develop recipe books over the last couple of decades to work out exactly what this catalyst is that you've gone and scrapped and collected. Does it come from an F-150, or does it come from a Toyota Corolla or a Golf? And that has a massive impact, obviously, on the economics underpinning that AutoCat. So with that technology, it does mean that the collectors and the industry as a whole has got a very good idea of the contained value. Now, I guess to go back to your question, does that drive accelerated scrapping? Does it drive a big focus on obviously getting the PGMs out? Absolutely. The collectors and the scrapyards are very good at splitting the metals out, really scrapping the entire vehicle from nuts to bolts and tires and chipboards and everything else. So there is a focus and an understanding critically of what is coming out of that vehicle. I would say that steel prices probably scrap steel still has a bigger component. I mean, obviously you and I are well versed in the quantities of PGMs that are coming out of these catalysts, and we're still talking, depending on the platform, a few grams of per catalyst. But at the same time, it does mean that the value of that contained metal has probably jumped from $200 to $600 a catalyst as a round numbers. So it is valuable. I don't think the industry, rhodium is obviously a very, very small component of that catalyst, once again, platform dependent. So I don't think the industry is going after the PGMs, as a standalone, but there is a focus on extracting the full values out of the PGMs. Now, I know you're certainly going to ask me about the theft of catalysts from cars, and because that is driving that behavior where, I mean, even the man on the street has got a very good idea of what that looks like and feels like. But at a sophisticated scrap collector level, I think it's really the whole of the vehicle that is still a component. And as mentioned, the scrap steel is really the key driver still. But PGMs is a valuable part of these businesses, without a doubt, and it has driven certainly accelerated volumes. We have seen our volumes step up pretty aggressively over the last probably 18 months, and I don't think we're alone. I think the industry as a whole has seen that.
And then I guess it's a theoretical question, but from your perspective, if we see prices fall, so rhodium prices, palladium prices, whatever, what impact does that have? In my perspective, from the outside, has always been it's a short-term blip, right? People might not sell, they might wait for prices to come up. There might be cash crunches and all those sort of things, but actually 3 months later, 6 months later, everything's back to normal. Is that something that feels right, or is there more to it?
Yeah, I think for the collector, once again, it's about churning their stock. So these are big scrapyards. They do want to churn the inventory very quickly, and it's actually phenomenal when you see it. You will walk into a warehouse that is packed to the rafters with stuff, and it's nondescript, and they've got their laboratories on the side, and they're busy analyzing and taking photos and updating their apps. Listen, I don't have a number on hand, but I would say that they probably churn that inventory in the course of 10 days, that warehouse will be empty and will be refilled once again. So I don't think the sophisticated collectors will wait on price to send. You know, that I think is a point to note. But having said that, you know, in terms of how the market has moved, people are getting quite, they are limiting their downside and possibly their upside protection, because, you know, we do hedge out all of our exposure, and we're passing those hedges on to the counterparts. So we are limiting that volatility on both the up and the downside, because obviously for us, when we're advancing money to a counterpart, the last thing you want is prices to go down and you're caught short in terms of the value that is coming out of the back end of your process. So there's still quite a lot of overlays of financial instruments to make sure that you don't have that volatility and that you are able to control it. But I think, to go back to the question, you know, I do think the guys are focused on the individual components. They may go and target higher value rhodium loaded catalysts because they know, as I said, through their catalogs and through their processes, they know what they're getting. But I don't know if they're going to be monitoring. I doubt that the really big guys will be monitoring a specific commodity price. And as I said, it is hedged out. So some of their participation will be limited, I think, for the good of the industry, frankly. Yeah.
And you touch on ESG, and I occasionally reflect, normally after a beer, which in short supply over recent months in the UK. But you know, when I took on a sales role, I expected to be doing more selling rather than worrying about ESG and tax and paperwork and things like that. But you know, do you see recycling almost developing its own product? And I think we've seen just the signs of that as you know, something that might trade on occasion, probably generally at a premium to private metal, and we can argue whether that's right or not.
Yeah, it's a fascinating point, because 2 years ago, recycling was considered, you know, dodgy, for lack of a better word. You know, it was we don't know where this is coming from. We've got this strange idea, and this is from a customer's perspective and a customer of the PGMs on the back end, and that narrative has certainly changed. I think we are seeing that people appreciate, and our customers appreciate, that this metal is green, that as long as we are doing what we can from a responsible sourcing perspective to make sure we tick all of the benchmarks and, you know, the LPPM's responsible sourcing criteria, which we do, you know, as long as we're doing that, I think we're passing that confidence on to our customers, who are then willing to look at this product with a premium, and who are willing to actually pay you a premium price over spot for that product, just because, once again, of those great, you know, emissions, the ESG component of this recycling. So this product is trading at a premium, but that narrative has definitely changed over the last probably 2 years, and I think it'll carry on changing.
I think for anyone listening, I think the words responsible sourcing may be mentioned at the end of this webinar by Taylor as well. It's something that's come up a lot more from LBMA perspective and the LPPM perspective. We certainly hear more about it ourselves. And I quite like the fact you touched on also that, you know, there is a reputational issue with recycling. It's whether that's fair or unfair is a slightly different question. But,
absolutely. Absolutely. And I think, you know, I mean, Dave, to maybe just build out on that, you know, I mean, it's a challenge. It is a challenge. I mean, we obviously go through a very, very detailed KYC process with our customers. We've got legal agreements that are becoming longer by the day to make sure that people adhere to it. And as I say, we do drive that responsible sourcing and dealing with counterparts that have a good reputation. Generally, we are probably dominated by very big customers, so we know who we're dealing with, and because of that fingerprint on the product, we also get a good sense when we are assaying it on the front end of our process. And once again, this will be similar across the industry. We get a good sense of where that product is coming from. So you're able to close the loop on the source, and have it's certainly not absolute, but it allows us to identify and have a very good idea of where it's coming from. Does it meet the criteria that we've set out in terms of the responsible sourcing, carbon, et cetera, and that it can be verified through technology and through attestation, effectively.
There's a question in the chat, which I quite like, actually, and I can answer as well, but I'm interested in your answer first. Do you think there's enough recycling capacity, refining capacity for palladium if volumes of secondary material rise by couple of million ounces in the next few years?
That's a very good question, Oliver. I think, and Dave, certainly like to get your views on this. I think it's going to be very region specific. I think without having the overlay, and once again, this is our internal thought, without having the overlay of a mining business to supplement some of the fixed costs associated with recycling, it becomes very difficult to justify building new capacity just for recycling in terms of our business model. I'm not saying that's certainly not the case for others, but for us, the economics are tough to make work. It's a very low margin, high volume business. So for us to build new capacity in North America, and then, sorry, the reason I'm going there is, in the North American market, which is probably one of the more efficient markets when it comes to closing the network on recycling, I would say that capacity is limited for those type of volumes. I think the other point to note is that the grade of a spent auto catalyst, when we talk about a ton of mine material and a ton of auto cat, the grading of an auto cat is much higher, of course, once you've concentrated it down and you've taken out all the steel and all the substrates. So you are talking about a grade that's materially higher, which means that your physical volumes required for smelting are lower. So you don't need that much capacity, but at the same time, I would say that you are still capacity constrained in North America. I think the European market might be slightly different, and I think the Asian market is slightly different. But Dave, would love to hear your view on this.
Yeah, so I'm many years ago I was trained as a chemist, and I'm not a pyrometallurgist, but I have heard more about smelting over the last 20 years than I probably wanted to know. And I think one of the interesting challenges is the precise question. It's not about the amount of PGM, which is a capacity issue of itself. It's about the mix of the PGM. So it's being palladium. If you're looking at, because historically Impala did a lot of recycling in South Africa, putting in lots of palladium into a process that's not designed for lots of palladium, whether that's a primary process or a secondary process. Go back into the 90s, there was no palladium in AutoCAD, is challenging. So I think that you've got this twofold thing. There's clearly at the moment, I think, some constraints on capacity. You'd expect those to be resolved. And the silicon carbide question is one of the issues that I don't think anyone's quite got an answer to, that I've seen at least. But you need both more capacity, and it needs to be the right sort of capacity. And that's kind of an interesting challenge. And then you place on top of that, if you believe in a BEV future, your construction might only be for X period of years. I tend to believe that the internal combustion engine is going for a longer time. So I think there is a business case to be made, but it certainly makes that business case a little bit more difficult to articulate. So I think what that means is we see a slower construction of capacity from anyone. And I think that means you still have constraints on volumes coming through, and probably good times for recyclers, right? Probably high margins throughout the next few years. These issues always resolve themselves, but it can take time.
And I mean, Dave, just adding on that, I think you're spot on. I think if you break down that processing line into a smelter, base metal refinery, and precious metal refinery, I think you'll have obviously different capacity constraints across that chain. You might find that you have sufficient smelter capacity, but then your base metal refining or your precious metal refining on the back end. And I think that, you've got hurdles across all of those areas for sure.
Yeah, it's complicated, I think, is always. I guess my other question, there are other questions, of course, and if you put them in the chat, if you've got them, feel free, of course. But one of the questions I've got, which I obsess about maybe too much, is culturally, how does it work when you have a recycling business sitting at a primary producer? Do you have the same, do you have the right mindsets, or how do you manage the mindset between the two? One's commercial, one's typically technical.
Yeah, no, it's a very good question, because I think probably 3 years ago, the recycling business was making more money than the mining business, just by virtue of recycling being a low margin, almost a fixed margin, because we're hedging out all the exposures. for us, it is incremental. So the amount of additional resources required to feed, a few tons per day, and I say a few, probably 20, 30 tons per day of recycled autocat into the smelter and blending it into our concentrate it doesn't require much more manpower. I think it's an interesting debate as we grow this business, because what do you do with this business? Do you, how does it work? How does it fit? To your point, Dave, you've got almost competing objectives here. But culturally, I think, for us, it has been economically sound to be in. I understand that. The working capital constraints are obviously there, and they are well understood. But for us, it really is just utilizing excess capacity, which I think that, certainly technically the guys understand and appreciate. As long as we're feeding the product, of course, that is your challenge. You need to feed it to get it through the system. Otherwise, you are going to get caught long, and then that's the last place you want to be.
Okay. I'll look at a couple of the questions here. One I might sort of answer, even that says, how does Stillwater view? How do people view growth in China recycling? Is there enough capacity? My view is there is not enough capacity in China, but China does not want to export material. It sees it as strategic. So I think you will see that construction of capacity. I think you've seen professionalization of that industry. I think if I went back 10 years, I would have not very many people I could recommend that would recycle in China. That might still be true, but there are certainly more now. But I would say that China recycling growth is going to be one of the interesting challenges, with the challenges of exporting waste, importing waste. Are you allowed to toll refine and return back? I think it's a genuinely interesting question, Lee, from there. And then the other one might be our last question, I suspect. But it's one that I find really interesting. It's someone says, and I'll just read it as it is here. So if you don't physically separate through the whole process, how do you segregate finally the fine metal out of recycling, right? It's a atoms versus traceability versus everything else kind of question.
It's a very, very good question, anonymous attendee. Listen, it's a very good question, because obviously it means that the focus on your metal accounting becomes absolute. We have the added complexity that we have a streaming agreement over our mined production. So you can now imagine you've got a streamer who's got a component of your mine production that's being mixed at the front end with your recycled production, and at the back end out is coming out a filter cake that's then sent on for processing. So we have the added benefit. I don't know if it's a benefit, it's probably not in these rhodium price environments, but our mines are not rhodium rich in the US. We have rhodium as obviously in the catalyst. So we almost have tracer metals that we know, and we can start allocating based on the metal accounting. And as I say, the rhodium was one of the key traces, as is gold. And we can then track that and trace that back to recycling. And then that really is the starting point. And through our assaying process as well, we're able to distinguish the two streams on that basis. So it really is a grading issue. It's a quality issue on the back end. We do assay the recycling, both the concentrate, of course, and the recycling material before it is fed. So we have that lead in terms of what those metals are containing, and then we know what comes out the back. So that does get very complicated, but it's a spreadsheet nightmare. But effectively, we are able to trace on that basis, and then work out exactly what comes in and what comes out, and allocate it to the appropriate stream.
Okay. So I can see Taylor's put up the slide, which is our sort of signal that we've run most of our time. I guess, I don't know if there are any sort of final thoughts you want to make, Justin, or if you think we've covered most of the areas. I know there are people we haven't answered the questions. I'm quite happy to try and answer if we get those.
Yeah, no, I mean, I think Dave, no, listen, thanks for the session. It was really, really helpful. I know we've probably scratched the surface on this. There's still so much we can talk about. I mean, I think, as a business, I mentioned it at the start, we are focused on autocats. We can still dive into petrocats and all the rest. But that has got an added complexity to it. But I think, Dave, you touched on, the key challenge for the industry at the moment is silica carbide. And I know a question was raised, have we done anything? I mean, I think everyone is looking at it, but I think you raised the point earlier, Dave, that this is still, to the best of my knowledge, a nut that needs to be cracked. And it's going to be interesting to see what happens and how we get there. So I'll leave it there. But no, thanks, David. Thanks, Taylor, for the opportunity.
Yep. So over to you, Taylor, I think. But thank you very much.
Thank you both for joining us today. And just like Justin and David did say, if you do have any questions after this webinar, or you had them during the webinar and they weren't answered, please send them through to us at ask@lbma.org.uk, and we will make sure that Justin and David get them so that they can reply to you if they haven't already. And we thank you for joining today, but we do have a few upcoming webinars. So as you can see on your screen, we have, we like to do them bi-weekly now in 2021, although sometimes we have a few additional webinars, which is why we're not strictly following the bi-weekly, as you can see on your screen. So as David did mention, we are introducing some more responsible sourcing webinars. So the one on the 29th will be led by our new head of responsible sourcing, Alan Martin. I think he started around, I think, November, December last year. So this will be his first webinar. We're all very excited for it. And then on the 6th of May, we have another digital gold webinar. So carrying on the series, we'll have Sakila Mertzer hosting. She'll be hosting Guido van Stein, the managing director from Oris, and Dan Tapiro, the founder of 10T Holdings. And they're going to talk, they're going to touch on things that we've talked about in the previous episodes, but they're also going to talk a bit about how the development in decentralized technology can help the gold market, amongst other things, as well as carrying on the conversation about gold as a bit of a payment tool. So if you haven't watched the other four already, I encourage you to do that before the 6th of May. You've got quite a few weeks to do so. But of course, if you don't get time, don't worry, it can act as a standalone. Following that, we do have a webinar on the Indian gold demand, just surrounding Ashkaya Tritiya, and just finding out what's going on in that region of the world. So we have Jeremy East, LBMA Senior Advisor for Asia. We have Shekhar Bhandari, the Senior Executive Vice President and Business Head for Kotak Mahindra Bank. And then our final panelist for that is Sundaran PR, the Managing Director for India from the World Gold Council. Obviously, I've got far too many webinars lined up to actually fit on this page, but we do have quite a few more responsible sourcing ones lined up. I don't have enough room, unfortunately. But if you do have any questions about what is lined up, you can head along to our website, or you can head along to any one of our social media accounts, or you can email us at ask@lbma.org.uk, and we'd be happy to fill in any questions that you might have. So that's it from me. And again, thank you, David. Thank you, Justin, very much for joining us. And thank you to our audience for joining us as well. We've enjoyed hosting and having you participate.